Everyone. We'll get started in just a few seconds. Good afternoon, everyone. Welcome to the Environmental Law Institute's webinar, The Coastal Property Insurance Crisis, Policy Options in a Time of More Severe Storms and Rising Seas. We have a wonderful program in store for you today. My name is Madison Calhoun. I'm the Senior Manager of Educational Programs here at ELI. I want to give you a warm welcome to today's event and thank you for joining us. We so appreciate your time. I also want to give a huge thank you to our fantastic speakers who've put in time to prepare a great program for all of you today. We're so appreciative that they've joined us. Our speakers have also shared some resources for attendees, including a read-ahead document that was prepared specifically for this program. If you registered before last week, you should have received the read-ahead document in your email. But if you've not had a chance to read through everything, we encourage you to take a look at all of it. You can find all of those resources on the event webpage. We'll also post the link in the chat. There will be time at the end of today's event for questions. So if you have any questions, please put them in the Q&A box. You don't need to wait until the end of the program. Please just submit them as soon as you think of them through Zoom's Q&A function, and we'll get to them at the end. The program will also be recorded and posted to ELI's website for members to view later. If you're unable to stay for the full program, you'll be able to view it on the event webpage within a few business days. And with that, I will hand things over to our wonderful moderator, Jeff. Jeffrey Peterson joined ELI as a visiting scholar in 2022 after 40 years of experience in environmental policy development and program management, particularly focused on water issues. Most recently, he was senior advisor in the EPA's Office of Water, and before that, he worked for almost 4 years at the White House Council on Environmental Quality during the first Obama term. He's also the author of A New Coast, Strategies for Responding to Devastating Storms and Rising Seas, as well as facilitator of the Coastal Flood Resilience Project. Over to you, Jeff. Thank you all so much.
Thank you, Madison, and welcome everyone. Let's get right into the webinar. Our goal today is to provide you with some insights into the challenges that more severe storms and rising seas pose for coastal property insurance and what might be done to strengthen coastal property finance. Today's webinar is divided into 3 sections. I'll give a short introduction to coastal property insurance and the problems related to it as a general background. Then each of the panelists will offer their thoughts on the challenge, and following each of their presentations, we'll have a short discussion period among the panelists. And then finally, the panel will take questions from the audience, and please submit your questions as part of the Q&A or chat function. So before I introduce our panel, I want to quickly summarize some key points to keep in mind during the webinar. Climate change poses a significant risk to communities throughout the country, but communities along the coast face the combined impacts of more severe storms, bringing temporary flooding and permanent inundation by rising seas. Storms and rising seas bring floodwaters to homes and businesses, but they also threaten coastal ecosystems and critical infrastructure assets that provide essential services such as transportation, energy, and water. Coastal storms are a major risk to life and property, and major storms can deliver storm surges of up to 14 feet. A warming climate is causing an increase in the number of the strongest storms. And by the year 2100, NOAA projects sea level rise along the U.S. coast to average about 4 feet in the intermediate scenario, with an average increase of over 7 feet being possible. Combination of more severe storms and rising seas is projected to result in potential losses of coastal property running into trillions of dollars. Many low-income and disadvantaged communities are among those in harm's way. These communities are disproportionately affected by climate change and often lack the resources to respond to these risks. Many property owners along the coast rely on insurance to provide a financial backstop for flood and storm losses. And the insurance comes in several forms. The National Flood Insurance Program provides most of the insurance for traditional storm-driven coastal flood risk and is required by federally insured mortgages. Private insurance companies provide more general property insurance covering storm damages other than conventional flooding. And some states are now backstopping these private policies with insurance of last resort programs. These policies offer a degree of financial security to coastal homeowners and stability to the property financial system. Unfortunately, as climate change drives more severe storms and rising seas, insured damages to coastal property are steadily increasing. Anticipating sharp increases in damage claims from coastal policyholders, private insurance companies have stopped serving some coastal states. There have been reductions in coverage and some dramatic increases in rates. The read ahead paper that Madison mentioned describes changes to the coastal property insurance in states including California, Louisiana, Florida, North Carolina, and Texas. In response to increased risks and increased insurance prices, some owners are selling properties or foregoing insurance when not required by a mortgage. These trends pose risks to the financial health and security of homeowners and to the economy more generally. High cost insurance, or the risks imposed by no insurance will gradually reduce the value of coastal homes and that are the principal asset for many homeowners and lead to increased mortgage default rates. Mortgage defaults can be financially crippling for homeowners, and rising default rates could threaten financial institutions, including federal institutions that guarantee mortgages. Low-income homeowners are least able to absorb premium increases and least able to manage a sale or relocation. Declining coastal property values also threaten to lower municipal tax revenues and the capacity to repay municipal bonds. Taken together, the consequences of declining availability and increasing costs constitute the coastal property insurance crisis. This webinar is intended to provide expert assessment of this challenge and consider what steps should be taken to strengthen coastal property the general financial system. For example, improvements to the current system might include more reliable and sustainable insurance markets, better promotion of risk mitigation practices, more standard coverage packages, more affordable premiums for low-income people, and better protection of federal guaranteed mortgages. It's a complex problem with no easy answers, but we are fortunate to be joined by an expert panel with deep knowledge of these challenges. Alice Hill is the David M. Rubenstein Senior Fellow for Energy and the Environment at the Council on Foreign Relations. Her work focuses on risks, consequences, and responses associated with climate change. She previously served as Special Assistant to President Barack Obama and Senior Director for Resilience Policy on the National Security Council, where she led the development of national policy to build resilience to catastrophic risks, including climate change and biological threats. Jessica Dandridge is the Executive Director of the Water Collaborative of Greater New Orleans, where she focuses on water management, hazard mitigation, water justice, and the equitable community transformation through blue-green jobs and the renewable economy. She is the co-chair of the National Academy of Science, Engineering, and Medicine's Climate Resiliency Roundtable and a member of the Community Advisory Board for the Coalition to Restore Coastal Louisiana. Carolyn Kuski is Associate Vice President for Economics and Policy at the Environmental Defense Fund and was previously Executive Director at the Wharton Risk Management and Decision Process Center at the University of Pennsylvania. Dr. Kuski's research examines multiple aspects of climate risk management and policy approaches for increasing resilience. She's the author of Understanding Disaster Insurance, New Tools for a More Resilient Future, and an editor of The Blueprint for Coastal Adaptation. And Dave Jones is director of the Climate Risk Initiative at the UC Berkeley School of Law, Center for Law, Energy, and Environment. He was senior director for environmental risk at the Nature Conservancy from 2019 to 2021, where he focused on nature-based risk mitigation practices. He served as California's insurance commissioner from 2011 through 2018. He also founded and chaired the Sustainable Insurance Forum, an international network of insurance regulators developing climate risk regulatory best practices. So each panelist will give a brief opening remarks, and then there will be time for other panelists to add to that presentation, ask questions of the entire panel for a period of about 15 minutes for each panelist. With that, I'll turn the floor over to Alice for the first presentation.
Well, thank you so much, Jeff. It is such an honor to be on this panel with really the leading experts on insurance and climate risk. Of course, insurance is a backbone for the economy. It allows people to get back on their feet after a disaster. They can repair their homes, businesses reopen their doors, shelves are restocked. Without insurance, governments or philanthropies have to cover the losses, or the losses fall on the individuals themselves. And what we're seeing is some real upheaval in the insurance markets because of the changing risk, as Jeff has noted, from climate change. And if insurers leave, they don't want to insure a particular risk, businesses suffer, families suffer. And as Jeff has mentioned, tax revenues fall, there's less money for schools, police, infrastructure, the real estate market can stumble, and mental health suffers as well. The United States has a lot of property that's located very near our coasts. A recent estimate is that there's more than $1 trillion worth of property located within 700 feet of the coast. These properties' proximity to water bodies may put them at risk of extreme weather, hurricanes, high tide flooding, as well as relentless sea level rise from rising temperatures. In addition to homes and businesses, we have a lot of critical infrastructure that's right near our coastlines. We tend to locate our wastewater treatment plants right next to the water for obvious reasons. And we also have many military installations, airports, power plants, oil refining facilities, and other infrastructure right along our coastlines. We have more than 600 miles of roads and bridges located in U.S. coastal floodplains. All of those are at increasing risk from climate-fueled extremes. But climate change is altering the risk picture that we are all suffering under as Americans, as well as for insurance companies. You know, 40 years ago, the United States experienced on average $1 billion disaster. That's a disaster causing $1 billion or more in damage every 4 months, and that's adjusted to 2022 dollars. Today, the nation experiences a $1 billion disaster on average every 3 weeks. You can just look at the paper today or news feeds of what's been happening on the eastern seaboard, Maine and New Hampshire. suffering from 4 storms this winter. The pictures show that we have people in places that are flooding already, and we have structures that are not built to withstand the type of flooding that's already occurring. And that means there's a lot of loss, and there's a question as to who will pay for that loss. Weather-related disasters currently result in at least $150 billion per year on average in direct damages, and the frequency and intensity of such disasters are expected to increase in the near term. So insurers looking at that risk picture have a number of choices. They can try to raise prices. Now, often it's a highly regulated market, so you can't just, insurers just can't walk in and say, I'm going to raise my prices. Or they can stop writing policies. And we've seen both avenues pursued by insurers in response to the growing climate risks. If insurers choose to stop writing, there's a lot of pressure on the government to step in. And in fact, that's what happened with the National Flood Insurance Program. We had a number of floods in the 1960s. Private insurers looked at it and said, you know what, we're not so interested in insuring this risk. And eventually the National Flood Insurance Program was created. It hasn't quite worked as well as certainly those who conceived of the idea had hope. The program is about $20 billion in the red. It still is struggling to charge rates that reflect the true risk. Now, of course, if it charges rates that reflect the true risk, that means some policyholders will see premiums with really stark increases because they're living in risky areas like the ones that we're seeing on the East Coast right now. If FEMA, which runs the NFIP, has over the years tried to charge actuarially sound or rates that reflect the true risk, and it has run into repeatedly a buzzsaw from Congress as to making those reforms. Most recently, it's now being sued for its latest iteration in doing so by a number of states who say that it cannot raise its rates. We also see governments step in, as Jeff has mentioned, with state backup plans. We have about 36 states that have them. These are plans that people can turn to if they cannot find property insurance for their homes. But the number of insured in these backup plans is growing. According to Property Insurance Plan Service Office, a research firm that tracks such programs, those plans have more than doubled their market share since 2018. One plan that's gotten a lot of attention lately is Citizens of Florida. Florida obviously has a huge sea level rise risk. Citizens has become the state's largest property insurer and an essential component of Florida's $1.4 trillion economy. It has grown to provide nearly 20% of Florida's property insurance. According to a 2018 study by the University of Cambridge and Munich Re, if a Category 5 hurricane hit Miami and the Florida coast, it could cause $1.35 trillion in damages. That's more than $60,000 for every person in the state. Now, Florida regulations limit how much Citizens' rates can rise, and because of that, the insurer is backed financially by the state. So if a particularly destructive event were to occur, like a major hurricane or a series of storms in a single season, there's a chance that Citizens wouldn't be able to cover the losses. And then the question becomes, and the question is the same for other backup plans in states, what happens if the backup plan can't cover the losses? Some states say they'll put levies on private insurers or state residents. Maybe the state will borrow. According to Millman, a consulting firm, 21 states don't explicitly say how they're going to cover a deficit. And in their words, these plans therefore become magic hiding places to cover risks that get too big for the private market. And we know that the risk is growing. People love to live near the water, Over 120 million people live in coastal areas in the United States. In 1960, we only had 47 million living there. That's a market increase. But coastal areas account for less than 10% of the total land in the contiguous United States. So we're crowding into these areas that are at much greater risk. And the questions about how we build, so for those people in Maine and New Hampshire, building right up next to the coastline, and the questions about how they build, whether they actually elevate their homes or do other flood protection measures, rests in the hands largely of state and local governments. And those state and local governments have not kept up with the changes that we are already experiencing, much less those ahead. In fact, FEMA tells us that 2/3 of counties in the United States don't even adopt the most modern building codes. An important thing to know about our current building codes in the United States is that virtually none of them account for the future risk of climate change. So we're building stuff right now that is destined to fail with increased sea level rise and increased storms. Many of the counties that lack these building codes, even the most modern ones that are only looking back to past risks, are in our Gulf states. As Jeff has said, a lack of affordable insurance could trigger real estate crisis or a bailout from the federal government. It was Republican Treasury Secretary Hank Paulson who called what our current appropriation system for disasters is, he termed it climate bailouts, and that's what we're seeing right now. But the Government Accountability Office has said that this poses a great risk to really the economic security of the United States, to the US Treasury. And we're suffering from a lack of good options to how to ensure that we, no pun intended, but that communities have access to affordable insurance for property. We just haven't come up with the right choices yet today. And that's why I'm so excited to hear from Carolyn and Jeff and Jessica about what they're seeing on the ground as possible solutions to make sure that we have this backbone in place to bolster economic strength in the United States and keep people safe and prevent greater harm.
Great, thank you, Alice. Does anyone on the panel have an observation or perspective on Alice's remarks there? I have a general question. Maybe I could just start us off with. You talk about the different players involved, and there are so many players on the scene here interested in this problem, but they do seem to be kind of not that well coordinated. And have you thought or seen examples of places where there's been a successful effort to bring disparate parties from private sector and the government, federal, state, and local together to kind of think through more holistically and strategically what should be accomplished? Is there a role for the federal government to provide leadership here, or should it be up to the states?
Well, I chair, and Carolyn is the vice chair of a task force for the California Department of Insurance looking at solutions for the property insurance market in the face of climate change. We've, through that work, had a number of pilot programs. There's a lot of thought about community-based insurance so that you lower the premiums for an entire community based on mitigation measures that are taken. The NFIP includes that concept itself for communities that are interested in NFIP insurance, that because they're in the floodplain, they can lower their premiums if the community takes actions to reduce the risk. And that makes sense with wildfire or flooding, because sometimes you need a community-based, you need a whole seawall to prevent flooding. You can't just have an individual home put up some kind of barrier because the property next door with the physics of water will be flooded. So that makes sense. What we've seen less of is the uptake. And part of that is the structure, in my opinion, of the insurance. You know, insurers have been around for a long time. They're always going to find risks to insure. Property insurance is a big part of their portfolio, absolutely. But it was in 2015, I think, that the head of AXA, one of the largest reinsurers in the world, and those are the insurance companies that offer insurance to property insurers, so that if a big disaster happens, those property insurers can pull from the reinsurers to cover their losses. So he said a 2 or 3 degree world, that's 2 or 3 degrees Celsius above pre-industrial times, the heating of that level is uninsurable. And I think what's happening today, we're about 1.2 above pre-industrial terms. We're seeing the beginning of that. And I think it's going to happen well below 2 degrees because insurers write, property insurers write on an annualized basis, so they can get out. You know, the commissioners in the states can try to keep them there for a while, but they can get out and they can go write other risks, cyber, whatever you want to, you know, there are other risks to make money on. They're really not in the business of trying to figure out the solutions for the communities. That's not how they have historically acted. And there is a meme out there that insurance companies will solve this. It's been there for at least a decade, and we really haven't seen significant movement forward on this. And that's no way to criticize them. That's just the nature of their business model, and that's the way it's been. I think it's going to require action at the federal level to really bring home the problem and the risk, the greater risk to the economy of the United States.
Well, that would certainly be an interesting development. Anyone have thoughts on that?
Yeah, I was just going to also add, also this is Jessica Dandridge, for those who can't see me. To add to Alice, I think it's really important also to know that the National Academies of Sciences and Engineering and Medicine have been also having conversations on this. And we've actually just had a panel on this last year. The struggle is also that multiple federal agencies aren't speaking to each other. And I think Alice had already spoken to that, right? But they're not sharing data, they're not sharing information, and also their policies and even their grant programs, right? Community block grants are in direct affront to insurance, right? So we actually, in particularly Louisiana and other coastal cities, we're seeing an expansion of ports, we're seeing an expansion of the Army Corps of Engineer projects, but they're actually hurting insurance for residents that live locally or nearby those projects. And so there needs to not only be alignment in data, there needs to be alignment in values in order for us to get to a better insurance property system for both flood and homeowners. I also want to quickly say that this is not a relatively new problem. This is something that's been going on for 20 plus years. As someone who lives in Louisiana, this challenge has been ongoing. And the first time people had really had this conversation was after Hurricane Katrina. That's almost 20 years ago. And to Alice's point, I really want to double down that when people were rebuilding their homes and they said, hey, shouldn't we elevate our homes? Shouldn't we, get a fortified roof? No one offered that option, the state nor the federal government. There was no building code updates to make sure communities along coastal Louisiana, especially in a highly populous area such as Orleans Parish, would not flood again. And sure enough, it has flooded continually and continues to do so. So I want to also recognize that while climate change is creating a more pressure on the problem, and for us, which is why we're here today, this problem is ongoing and long-term, and many coastal communities, Texas, Louisiana, Mississippi, have been grappling with the challenges of insurance for a while.
All right, well, I think we should go ahead and move to our next speaker. And Jessica, actually, you're our next up on our agenda, so I'll turn the floor over to you.
Thank you, Jeff, and thank you. I'm so honored to be next to some of the panelists, and I appreciate the invitation to speak. For context, I run a community-based organization called the Water Club of Greater New Orleans, and we work on a variety of issues, including nature-based solutions. And so one of the reasons why I was invited to this conversation, particularly with the National Academies, is that on working with nature-based solutions, we were not seeing that reflected in insurance rates on the municipal, the regional, or the state level. And that is an ongoing problem that we have. And I want to kind of set the tone. I saw there was a question, an earlier question about that experience in coastal communities. Louisiana, I also would say, I would argue Mississippi and coastal Texas is not the same as maybe coastal Florida or coastal California. These communities tend to have higher poverty rates, tend to be not only Black and Indigenous, but also you have a lot of migrant communities that are working in offshore drilling. They're working in oil and gas, expanding oil and gas, as well as fisheries and many other economies. So people tend to be actually poorer along coastal Louisiana and along the Gulf of Mexico than you would argue in, say, a place like Miami or Fort Lauderdale. I just want to kind of set the tone here and also the picture. I just did a coastal Louisiana tour last week. When we went out to the United Houma Nation, which is an indigenous tribe, really struggling to rebuild after Hurricane Ida. On the way there, you see, tarps on roofs. This is Hurricane Ida, for those with context, hit almost 3 years ago. And Hurricane Ida was a windstorm. So really there was some obviously flooding, but it was mostly wind. So you had tarps on roofs. You had people who were literally living without power, without electricity, with nowhere to go. And many of the people we spoke to in this coastal tour said, we've been basically fighting our insurance companies for years, not a month, not 6 months, years, having to sue them to get exactly what they need, to get any type of recognition for the services that they need. And the insurance rates are skyrocketing on top of that. Most people, especially for homeowners insurance, have left Louisiana. And I want to just kind of pull out a few statistics for you because I think it's extremely important to know and to order to set the context on what it's like living in coastal Louisiana and living in the Gulf of Mexico for coastal communities. In 2023, premiums, and by the way, this is the Louisiana Department of Insurance, the premiums rose an average of 63.1%. 63%. For coastal plans, which means if you live in a designated flood zone, that's 65.6% increase. But it doesn't get better from here. The homeowners insurance rate for Orleans Parish, which is the most populous, again, community in Louisiana, you think of New Orleans and other places, that is 81.7%. That's 24.7 million policyholders. St. John the Baptist Parish, which is further upriver, that is 111.3% increase in homeowners insurance from the Louisiana Department of Insurance. Lafourche Parish, which is a coastal community, one that I had just told you I did a coastal tour in, lots of fisheries, lots of oil and gas exploration, 88.3%. That's roughly 1.8 million policyholders. For the NFIP, this is where it gets really troublesome. Orleans Parish, again, that is a 92% increase, right? For the average amount of your premium for an NFIP is $1,326. That's not including your homeowners. That's not including your mortgage. That's on top of, right? You guys know that. St. John the Baptist Parish. By the way, St. John is not a coastal community. It is a further upriver. It is near the Mississippi River, but it is not a coastal community. Their insurance rose 144%. The premium average, $1,903. And then for Lafourche Parish, which by the way, the poverty rate is about 20% in Lafourche Parish, the NFIP rose 376%. I'm gonna repeat that, 376%. And the average premium for a policyholder is $3,270. Again, not including your homeowners and not including your mortgage. It is basically impractical and unaffordable to have insurance, both homeowners and flood insurance, especially when all of the communities that I mentioned have a poverty rate that is over 10%. So I just want to also make it very clear that on the ground, it is nearly impossible to navigate the situation for most homeowners. And as I mentioned in my last comment, that the building codes of Louisiana do not support risk mitigation efforts on a mass scale, not even on a localized scale or an individual scale. There is no benefit or very little benefit now to especially elevating your home, getting nature-based solutions around your home, or even seeing any type of gray infrastructure increases such as levee systems, canals, ditches, and so on. The other thing I really want to point out is the challenges, and I think Jeff has spoken to that, and Alice, and I really want to elevate that, is that you have communities that are shrinking at a rapid rate. Louisiana ranks top 10 in the country for loss of individual residents. That is extremely high, especially when you compare it to the neighbors on that list, California and New York, that have millions more people. Louisiana is a relatively small state. And so for us to have the top 10 people leaving the state, and it's incredible, it's partially because of insurance rates, among other things that people are considering. So you have a mass amount of climate migration because of the cost and increasing costs, but the people who are still there are the people who cannot afford to leave. Those are the ones that have the highest risk. Those are the ones that are living without their utilities. Those are the ones that are living without any particular support from local or state government. I just want to kind of point out, because I can go on and on about that. I see there's a lot of movement in the chat about some of the things that people have mentioned in terms of challenges and solutions. One of the things that I keep saying is it needs to be people-centered, particularly people-centered risk mitigation. It is possible to do that. And that's not just elevating your home or building catch basins or ditches or whatever you want to, what makes sense for your community. It's also about building community into those solutions, having them be a part of the building of that. That is one of the reasons why Katrina, if you look at Hurricane Katrina and the impacts of Southeast Louisiana, why it failed. Many people have argued that Louisiana is worse off post Katrina because those plans did not include people. And it did not include increases and changes on how we understand insurance and how we build around that. So one thing that we're doing at the Water Collaborative is building the first ever community-centric stormwater fee. And so that's a unique way to raise funding, but the funding won't just go to gray infrastructure. It'll actually go to risk mitigation. So elevation of homes, creating of nature-based solutions on community scale, so we can actually see community-based insurance and parametric insurance enacted in Orleans Parish and hopefully across the state. That's just one small solution. The other thing I really want to talk about is the disconnect that we have between development, jobs, and insurance. So while we are talking about people needing to leave, the opposite is actually happening in Louisiana. They are building more and more offshore drilling, we actually have the largest offshore wind farm going in by 2025. We also have the largest LNG plant. Venture Global is building one of the largest LNG plants in the United States, and it's off the coast of Louisiana. In order for them to mitigate their flooding that they know they have, they built a levee wall around a 630-acre site. Around them is people living in trailers, people living without electricity or running water or sewage, people living in elevated homes. So what that means is if there is a hurricane, the community around them is more prone to flooding because they built a wall. If you know how water works, that means that the water is going to just build up where they live. It is putting communities more at risk. And what are they doing? They added 2,000 jobs to this new Venture Global LNG plant. They're all people from outside of Louisiana. Every single one of them. Not one individual from Louisiana got those jobs. But in response to that, the state is paying for them to rebuild parts of Plaquemines Parish to create communities for these incoming workers. What sense does that make? We're talking about insurance. We have people who are living in deep poverty, but then you're building one of the largest plants and you're continually expanding on that plant. So most people in Louisiana are stuck there. The jobs that they've been trained for, the jobs that they know how to do are coastal jobs. Where do you plan to put these people? And with that being said, climate migration needs to have a strategy. We actually have a failed experiment on that called the Ile de Jean Charles, and I encourage everyone to look that up. Ile de Jean Charles was an experiment by Louisiana to do just what we're talking about. Well, this community, I just came from there last week, is literally underwater. Every single side of this community is surrounded by water. They failed and butchered this program to no end. This is an indigenous community. They didn't actually create a mortgage system that worked for people. They didn't know how to deal with properties being given to family members. What if a family member has multiple children? They never thought through those plans. And so most people in that program ended up losing, or they didn't participate in it altogether. So I'm actually working with an organization called Climigration to actually create plans for climate migration that actually work, and again, that are people-centered. The last thing I'll say, which I alluded to, is that we have, again, conflicting reports with federal agencies, right? So FEMA is saying we are increasing our costs, but the program actually allowed for growth in Louisiana. So we wouldn't see the growth that we have there if it wasn't for the NFIP program. We have to keep that in mind. So if we want to fix it, we also have to realize that it created the problem that exists today. Also, federal regulation oversight, we have expanding ports in Louisiana, expanding ports in Texas, expanding ports in Mississippi, that actually support growing flooding and increased flooding. Louisiana loses about 1 hour a day of coastal land. And many of the organizations, one of them I sit on, the Commission for the Coastal Protection Restoration Authority of Louisiana, took money from the BP oil spill, $50 billion, to reinvest in coastal Louisiana. One of those projects is called Mardi Gras Pass, where they said, hey, we can rebuild the Mississippi River. It can do its job by itself. They have other massive, amazing engineering, feats of engineering projects. And what's standing in the way of that? The Army Corps of Engineers. Every time we get a large project, the Army Corps of Engineers pushes back and they say, but we need to continue to dredge. We need to continue expanding ports. So which one do you want? Do you want to have expanding ports, expanding income, or do you want to have communities that are thriving? It is possible to save coastal Louisiana. It's possible to save parts of Mississippi River Valley. But in order to do that, you need to invest in nature-based solutions and great infrastructure together. But you have to have policies and values that align across multiple institutions and agencies. So I just wanted to kind of paint a picture that it is a very complicated situation. It's not as simple as fixing the NFIB program. It's not as simple as fixing homeowners insurance, and understanding all of these homeowners do not have the ability to leave. They do not always have the ability to be bought out, and they don't always have the ability to expand or create risk mitigation on their own land, as we've already discussed. It's going to require multiple institutions to participate in the program, and it's also going to require homeowners to be supported in this process and having it be people-centered. So I'm going to leave it with that, without me going off on my my elevator pitch here. But thank you so much, and I'm happy to take questions, Jeff.
Yeah, that's great. Thank you. Anyone on the panel have a thought based on Jessica's comment?
Well, I would add, I think that Jessica has described what other communities are beginning. I think Louisiana has experienced it earlier, but these are extremely hard issues that will require coordination and planning. That's the reason I think that the federal government needs to take a more concerted role here, not just in insurance, because really underlying the insurance is the question of where people live and how they build. We have, as Jessica said, populations that are already there, but we're also adding to those populations and increasing our problem. And that's because to some extent, because of perverse incentives that governments have created to allow development in areas that we now know are very dangerous. Essentially, we've created a moral hazard with the NFIP, the National Flood Insurance Program, but also not requiring where communities take federal dollars that they build in a more prudent way and in a way that accounts for these risks. We don't have a national adaptation plan. The United States really is behind in its vision for how all these different contributors need to coordinate with each other to say what the federal government will be doing, what the state, local, tribal, territorial governments will be doing, what the private sector is doing, and then really what individual, in case of property insurance, homeowners need to be doing. There's no overall plan. It doesn't have to be highly detailed, but we do need to define the roles so we're not getting this mishmash of conflicting signals that allows for continued investment in areas that we know will be underwater in our coastal regions.
Also, thank you, Alice. And I also I'm going to put some of the links in the chat for the data that I cited. So one of them actually is gao.gov, but I have another one I'm going to put in the chat from Louisiana Citizens that you can actually see some of the insurance rates that we have. And I also saw a question from me, which is, can you speak to how insurance coastal resilience issues affect marginalized communities and how the disparity should be addressed and solutions approach? I think I spoke a little bit to that. I mean, marginalized communities can't leave, and they're the ones that are on the front line. And if you, again, go through any part of coastal Louisiana, you see people living in deep, deep poverty. We're not talking about, you know, I don't have a pool. These are people who barely have a house. And I've actually met several community members, elders, as well as children living in homes with holes in the ceiling, with broken floors, living in standing water, because they don't have insurance, or their insurance companies went bankrupt, or they are in the middle of suing them. So many people in Louisiana are living like this. This is not, you know, one particular parish or one particular community. And indigenous communities have an even harder time, because if you're not federally recognized or state recognized, you have to go through an even more arduous process to apply for insurance. So those in two particular communities, indigenous communities, are really stuck out, and are also facing affront from the Army Corps of Engineers, because many of those coastal communities work in fisheries. They work in shrimping, oysters, you know, other fisheries, and they are seeing increases in their risk, but reduction in their ability to navigate the federal systems. How that can be addressed is what Alice just said. You know, we need to have coordination amongst these agencies. There needs to be planning, and that planning needs to include communities that are on the front line. It can't just be, a lot of times when I read articles about insurance, they cite places like, you know, Maine or Miami and California, and those are important to the conversation, but they actually also have to include impoverished communities that are on the front line. And also not adding to the problem. You know, we're talking about climate change, but you're building the largest LNG plant, over 630 acres large, that is contributing to climate change. So there needs to be alignment in this. And also, you know, the Biden administration has done a lot of work with the Infrastructure Investment Jobs Act that can help these communities. But on the flip side, opened up offshore drilling in the same process, while, you know, as part of the plan. It can't be both sides. And I know Louisiana is a hard place to work because of its politics, but these are communities that are not only working in oil and gas, but are falling victim to oil and gas as well.
All right, thank you. I think we, next up speaker is Carolyn Kuski, and I'll turn the floor over to you, Carolyn.
Great, thanks, Jeff. It's an honor to be on this panel with such thoughtful and insightful colleagues. I'm going to build on Jessica and Alice's remarks, and I want to talk a little bit more about inclusivity and equity in our insurance markets. So let me start by what you've already heard, which is that insurance is a really essential part of our disaster safety net. As we've all been talking about, disasters are these really severe financial shocks for households. There are times when expenditures go way up. It's the really massive property damage, but a whole range of non-property costs as well. And we also see that it's also a time when many households lose income at the same time they have this spike in expenses due to business interruption. And we know that most households just don't have enough savings to cover these costs, can't access credit, and we know that federal assistance is woefully insufficient and can take a really long time to get to people. So that's why insurance is really critical, and why research finds when the process is working, and I want to come back to that because Jessica raised some of these challenges too, but when the process is working, that those with insurance are more likely to rebuild faster, and lack of insurance can widen inequality. A colleague at Freddie Mac and I, in some recent research, have found that households with insurance are much less likely after a hurricane to have high financial burdens in both the short and medium run, are much less likely to have unmet funding needs. And we also find that post-disaster visitation rates to local businesses increase as more people in the community have insurance. So there's spillover benefits to having insurance to the local community and local economy as well. Unfortunately, though, in some work we reviewed the related research on this, often what we see is really kind of two groups of households, like sort of a have and a have not when it comes to disaster recovery. There's a group that have insurance. These households are also the same ones, though, that are most likely able to make use of other sources. They're more likely to have savings, to be able to access credits, to navigate the government assistance program, and so to put together all these different sources to get to more complete and faster recoveries. They tend to have higher levels of financial literacy to navigate all the difficulties of many of these sources of funding. And then we have another group of households that are uninsured, usually because they can't afford the coverage, which means they're also much less likely to have savings to draw on and can be locked out of access to credit. And instead, they have to draw on friends and family for their recovery, which is helpful and wonderful, but also has severe limitations and scale, right? We see in our research that aid from friends and family comes faster, but is much less than other sources, particularly if your social network lives near you and they were also impacted by the same disaster that you were. So we've been undertaking some work around at EDF around how to make a more inclusive disaster insurance system. And we define an inclusive system as all the policies, programs, and products across the public and the private sector that make appropriate and affordable insurance available to those who are unserved or underserved by the market. And in a report on this last year, we found that there's actually many barriers to inclusivity right now in our markets. A first one is insurance gaps. Many households just don't have disaster coverage that they need. It's often carved out of standard homeowners policies. We already talked about how flood is not included in your standard homeowners or standard property policy. And we also see additional limitations on coverage provided for disasters. So things like full exclusions for things like flood or mold or other damage, but also sublimits, meaning your insurer isn't going to pay you as much if the loss comes from a disaster, or higher deductibles, meaning you have to pay more of the loss yourself if it's from a disaster. And often you can purchase complementary coverage. You can purchase additional flood coverage. You can purchase endorsements to increase your coverage, but that gets to the second challenge. Most people can't afford that. And disaster insurance is fundamentally more expensive than non-disaster insurance, because when you have correlated and catastrophic losses, that stresses our basic model of risk pooling. And the way we kind of get around this through things like Alice was talking about, global reinsurance, costs money, and that gets passed on. And so it makes it more pricey, and often can make disaster insurance out of reach for the households that need it the most. We also see that some post-disaster needs, particularly non-property losses, are just not well met in our current market. There's not products to really help with these. So for example, for renters after a disaster, often the biggest cost that they face is higher rents, because demand goes up and supply goes down. And so rents go much higher sometimes after a disaster. And we don't have an insurance product to protect them against that type of cost. Finally, while the research seems to say that direct discrimination in insurance markets is likely limited, there is concern about indirect discrimination, including procedural inequities in accessing fair claims payments, and kind of that contentious negotiation that you often have to go through with your insurer around issues like the rising use of AI and machine learning for pricing, and also just simple correlations between climate risk and race or income. And since the cost of insurance includes not just the risk of the hazard, but the full likelihood of damage that the insurer is going to have to pay, it's also influenced by things like historical disinvestment in neighborhoods' infrastructure, and inability to afford protective measures or deferred maintenance. All of that can wind up meaning that the insurance costs more, is less available. So all that was to say, our insurance system is not really meeting everyone's needs right now. And so we've been looking at a range of interventions to improve inclusivity in the market. This includes policy changes like means-tested assistance for flood insurance, which has been talked about for over a decade in Congress and still hasn't been adopted, or things like the creation of mandatory or voluntary systems akin to a Community Reinvestment Act for insurers. We're also exploring regulatory reforms like baseline coverage standards, or regulations that would enable new approaches, which brings me to the last one, which is new products that the private sector could offer, sort of innovations in the way we offer insurance. And I want to just take a couple more minutes to kind of do a double click on this idea of what we can do in terms of innovations on the type of products. Many groups have become interested recently in using something called parametric insurance, which is been used for a long time. And basically, instead of having a loss adjuster come and look at your damage and kind of you argue with them about what you're owed, a parametric policy pays a predetermined amount based on an observable metric of the hazard itself. So I think it's easiest to think about like wind speeds within so many miles of your house exceed a threshold, you automatically get the payment. That has opened up a lot of other types of approaches. One is like microinsurance, which has been used for many, many years now throughout the global South. It lowers the transaction costs of providing payments when you don't have to do that loss adjustment. So that changes the business model a little bit and lets you offer policies in places that otherwise would be difficult, and also allows you to offer policies that are smaller in amount and more targeted at poorer populations. Microinsurance currently is only really available in Puerto Rico. They're the only US jurisdiction that has created that market. Another approach is taking kind of a group or community approach to providing insurance, where you have an intermediary sitting between the insurer and the beneficiaries. And there's a number of ways you can design this. And the idea is just to provide greater coverage for greater numbers of people. So one would be something like an employer model with your health insurance. An employer often negotiates with an insurance company and gets some pricing and a couple models, but then employees end up paying at least part of the premium, right? But you could think about taking that model for disaster insurance and replacing the employer with any other type of group, a local government, a community organization. Another thing is to embed insurance in products or policies or programs. And again, this has been done in many different places around the globe. One common example is in agriculture, providing sort of crop insurance or livestock insurance that's tied to things like the purchase of the seed or the feed, or tied to your loan so that you automatically get the insurance protection. And then a third model, and this is the last piece I want to talk about, is actually an intermediary sort of using insurance to help finance assistance for a group of people. And this was an approach we took in New York City in a recent pilot that's only been up and running for a year now. So working with the Center for New York City Neighborhoods, the Mayor's Office of Climate and Environmental Justice, and two private sector partners, Guy Carpenter and Swiss Re, we designed one of the first rainfall-related flood parametrics. And the idea is to provide fast and flexible dollars to help with the immediate needs that low and moderate income households can face right after a severe flood, and to get them that assistance to prevent sort of a downward financial spiral when they don't get the dollars that they need for those immediate post-disaster costs. So the Center for New York City Neighborhoods has secured this parametric product. And if triggered by a qualifying flood, we'll use the dollars to make these emergency grants to households in their pilot neighborhood. We've put together some lessons learned reports on that and how other communities can not just necessarily replicate this exact model, but replicate the approach of identifying the kind of holes in the safety net and how to design programs to start filling them. And with that, I will stop and turn it back to you, Jeff.
Thank you, Carolyn. Thoughts from anyone on the panel? Carolyn's presentation, that was really, really interesting.
Well, I'll just say that Carolyn and others are really trying to pioneer solutions that are attractive to insurance and insurance companies, and that will better preserve the market. So kudos to her because she's working on the solution side here versus just looking at this growing problem and throwing up her hands.
I'll just echo, though, that these solutions are only part way, right? And to really stabilize the market and meet needs, it's what Jessica and Alice were talking about. We have to lower our risks and invest in all those resilience measures as step one, just to be clear on that.
So you've talked about sort of the difference between government action and what insurance companies can do. And, you know, I think we've been talking on the panel now about where does the responsibility lie for trying to get toward a better system? Should we expect insurance companies to figure this out, or should government play an expanded role? And if so, you know, how should it be? And I think a good example of that is the question of, well, relying on the price signal does send a useful message to people that they're living in a risky place and that maybe they should consider making some improvements to reduce their risk or even relocating. But the government maybe has some responsibility as well in terms of providing for good information about the risk and disclosure that may be hard for an individual to find if there isn't help in terms of the government disclosing the risk that an individual community or individual homeowner has. Do you see a benefit in focusing on one side of that equation or the other, the insurance company versus the government role, or do they both kind of need to work in coordination?
So maybe that's a great segue to my remarks, Jeff, if I may, and in the interest of time. So it's been a real privilege to get to spend some time with each and every one of these terrific panelists, and I really have appreciated all the insights and wealth of knowledge that folks have brought to bear to this discussion. But yes, Jeff, one of the important things that insurance does is act as the canary in the coal mine with regard to the climate crisis. And insurers are rational economic actors, and as each of the speakers has alluded to, because of climate-driven risks and losses increasing, particularly but not uniquely on the coast in this country, it's happening in various geographies with regard to various climate-driven impacts. Insurers are losing more money, and so they raise price and they stop renewing or stop writing new insurance. And so there's a felt need to try to address that, and I want to talk a little bit about how we might address that, as the other speakers have as well. But I think it's also important to recognize that, in my view, it would be a mistake to artificially suppress the price or artificially require private insurers to write in areas, because right now there is really no other signal out there other than the tragic damages that are occurring, and with greater acuity for communities of color and poorer communities because of where they're located. There's no other signal out there to send a signal to markets, local decision makers, state decision makers, federal decision makers, developers, lenders, that these are really risky places in which to develop, and we got to stop developing here, right? So if you want to have an insurable future on the coast, it seems to me first and foremost, you have to look at what's driving this risk, and that's climate change, which is driven by greenhouse gas emissions. So we need to accelerate the transition away from fossil fuels and greenhouse gas emitting industries. And what can insurance companies do in this regard? Well, Series issued a report last year based on data that I collected from insurers when I was insurance commissioner in California. They found that insurers have $569 billion in the fossil fuel industry. Now, why the heck are insurance companies invested in the very industry that's contributing to their inability to write insurance in coastal areas and other areas across the United States? Similarly, insurance companies are insuring the fossil fuel industry. So one contribution insurance companies could make is stop insuring and stop investing in fossil fuels. And I think that insurance companies ought to be required to prepare net zero transition plans with a very short time horizon, which indicate how they're going to get to net zero in terms of their investment portfolios. Insurers have trillions of dollars of investment. To the extent that they're investing that in fossil fuels, it's not helping us transition. Conversely, while there's been some insurance company investment in green bonds and other investment types that help to move forward with the transition, there's not enough. Okay, so but then what do you do about the fact that, as everyone has said, insurance is becoming impossible to afford, particularly for low-income households, and increasingly unavailable in these coastal areas? Well, first, there's always a desire to potentially create some national program and intervene nationally and perhaps create some national subsidized insurance scheme. Well, we have an example of that, the National Flood Insurance Program, and as each of the speakers have alluded to, that hasn't gone very well for a number of reasons that have already been discussed. And so I'm very skeptical about creating some national scheme of insurance coverage to substitute for the private market. But we need to do something. And so if we don't want to suppress the price, which I think is a mistake, and we don't want to artificially require the private insurers to write insurance in areas because we want to keep setting that price signal, we need something. So what do we have right now? Right now we have what are called residual markets or FAIR plans that operate in 37 states. And yes, Milliman did a study, as Alice alluded to, that found that some 21 of these FAIR plans don't have really detailed explanations as to what they're going to do in the wake of a shortfall. But Milliman also found that almost every single one of them does have language in their either their charter or their state enabling statute, which says that the FAIR plans, in the event of a shortfall, can surcharge insurers. FAIR plans are basically involuntary associations of insurers, and they're writing an insurance product in various states for the risks that the private insurers won't cover. And that's where people are being forced to when they can't find private insurance. Yes, there are challenges with the FAIR plans. Okay, so what could you do to try to shore them up? Well, one policy solution that's been surfaced is a national reinsurance scheme. Adam Schiff has introduced a bill to do this that would not be limited just to the FAIR plans, but provide a national reinsurance pool for all direct writers of insurance. My concern about that is that would be a significant federal subsidy for private writers of insurance. And, its goal is to try to reduce the price of insurance or make it more available. And I'm concerned about doing that in the very areas where we want to be sending a signal that we shouldn't be doing new development. So instead, you could narrow that federal reinsurance program to FAIR plans. But I would have some strings attached to it. I would say, look, if we're going to create a federal reinsurance facility for FAIR plans and help reduce the price of the FAIR plan, we got to require a couple of things. One is states ought to enact a premium subsidy for low-income households who are purchasing FAIR plan policies. Make it means tested, and make sure that the coverages offered by FAIR plans are broader coverages than just narrow coverages for fire, for flood, or for whatever. Right. Second, I would condition any federal subsidy or reinsurance facility, again, limited to FAIR plans, but even more broadly, if that's where things go, to requiring states to enact legislation to limit or restrict new development in high-risk areas. Now, that's controversial, I know, but we simply have got to limit the amount of new development that's occurring. Now, maybe you could have exceptions for high-density, multifamily, permanently affordable housing, or certain housing stocks that are necessary to meet the needs of low-income families, or permanently affordable single-family housing. But it seems to me that before we stand up some federal subsidy scheme to try to make either private insurance more available or FAIR plan insurance more available, there ought to be strings attached to require restrictions on shoveling more people and businesses into the high-risk areas, and then also doing the things all the other speakers have talked about with regard to requiring higher building codes and more investments in resiliency, including nature-based investments. And in the interest of time, I'm just going to go there now. So Jessica talked about some terrific work that she and her team are doing with regard to trying to encourage nature-based mitigation. And she's spot on that insurers are not currently accounting for nature-based mitigation in either their underwriting modeling or their rate modeling. Here's some examples of how nature-based mitigation can make a real difference. In the wake of Superstorm Sandy, the U.S. Geological Survey did a study that found that those communities along the New England and southeastern coast that had intact salt marshes avoided about $629 million in economic losses versus those communities that did not have salt marshes. So it turns out replanting salt marshes can dramatically reduce risk. But we also need to require the insurers to reflect that in their insurance modeling and rating. When I was at the Nature Conservancy, I did a joint paper with Munich Re that looked at river flooding and a nature-based approach to reducing river flooding, which is setting back levees, good for nature and ecology, but also reduces flood risk. We're able to show that not only did it reduce losses associated with floods, but it could be modeled and accounted for in insurance modeling. In the South Bay of San Francisco, there's a project currently underway in San Mateo County to look at replanting salt marshes there and look at the risk reduction benefits associated with replanting those salt marshes in combination with existing gray infrastructure like levees. So these are some examples. There are others outside the coastal context as well. So yes, I agree with those speakers that have said, look, we need to invest more in these nature-based mitigations that are empirically proven to reduce risk and reduce loss. We also need to require the insurance companies and federal insurance schemes like the NFIP to recognize those investments in their rating and in their underwriting. And that's going to require legislation. And since we regulate insurance at the state level, it requires state legislation. If you want to make sure that the NFIP accounts for it, you need to do federal legislation. So I'll stop there, but I think that importantly, there is this tension, as Jeff alluded to in the segue to my remarks, between the felt need to make sure that insurance is available to everyone at an affordable price, both individuals and businesses, but at the same time, trying to make sure that we are not sending the wrong signal and encouraging more development, population increase, more assets at risk, whether they're public assets or private assets, as Alice talked to, in the very areas where the risk is highest. So we've got to strike a balance between those two things. And I've offered one suggestion of how we might strike that balance. I'll stop there.
Great, thanks, Dave. Comments from the panel? One thing I did want to ask you about is I understand that California has a policy. I don't know if this was something you were involved in, but that basically says that if your home is damaged by a storm and you're going to be paid a substantial amount in your insurance policy, you have the option of either restoring the property on the site where it is, or taking the payment you would have received and using it to buy a different home, ideally in a safer place, and essentially a financing tool to assist to relocate, not a full buyout, but not forcing you to rebuild in that same place. Is that a policy that you think would help make it easier for individuals to adapt to the changing risk that they're facing?
Well, that's a standard clause in all standard homeowners insurance policies in California. You have the ability to take your insurance payout and rebuild your home on site, or take it and build a new home somewhere else. And so, and I think that's true of the H06 policy form, which is the standard policy form used in every place in the United States. But I want to just respond quickly to a question that Rusty C has posed in the chat, which is, saying, look, if we don't suppress insurance prices, that's going to impact on the poor. Yes, but what I'm proposing instead is don't suppress the price, but rather provide a premium subsidy, means tested, for those that can't otherwise afford it. And we have a great experience with that in the Affordable Care Act. We've done exactly that across this country with regard to insurance provider and health benefit exchanges, where the prices charged by the HMOs and the health insurers are what they are, and they're sending an appropriate price signal with regard to the cost of providing medical care plus their profits. But we subsidize the premium for lower income and middle income households of those that are buying health insurance in the exchange. You could do the same thing with regard to FAIR plans. It requires state legislation, a state premium subsidy, or maybe enact one federally and provide it to the FAIR plans. But that then balances that tension between not suppressing the price signal, but also helping those that are in greatest need make sure that they can afford an insurance product.
Jeff, I want to jump in, and I completely agree with Dave's policy proposal here. I think that makes a lot of sense, but I also want to circle back to your earlier question about information and signals, because yes, insurance is a really important information and financial signal, but we also need to know that it's only this year's risk. So it is not a good tool to be signaling and creating the incentives about how risk is changing over time with climate change. And we need public sector solutions for that type of thing. Also, the insurance signal comes at the point when you go to try to buy your insurance. And we know that sometimes that's pretty late in the process for decisions where that information might be a lot more impactful if people got it earlier. And so there's been work, for example, around flood insurance, that in the home buying process, people don't get that information on their cost of flood insurance until close to closing. And you're really, committed to a property at that point, and it might be hard to make different decisions. But if you knew the first time you stepped into a new home that you were thinking about, that the cost of flood insurance was whatever it is, and not only that, but because this is an area of increasing risk, you can expect that premium to be going up year on year. And information like, hey, this has had 3 prior losses, you might think twice about going further with that. And I think that type of transparency is really critical to make sure we're not accidentally trapping people in high-risk areas who would have preferred not to be in the high-risk areas if they'd only known. And unfortunately, here, this is me getting on my policy soapbox now. For flood insurance, it should be easy. We have one federal program. Prices are set nationally by FEMA, and it's a trivial exercise to create an online lookup tool where you could put in any property address, get the premium, get the flood information, get prior losses for anyone. And we're not allowing FEMA to do that. So that's my policy. Yeah.
I also want to just chime in too about the concept of relocation. I agree with everything Dave said, but I do want to pose that we have to think, and I'm really honing in on this planning part, because a quarter of Louisiana alone, we're not even talking about the other Gulf Coast states, is supposed to be underwater by 2050. And I actually put a link in the chat, which is the Coastal Master Plan for 2023. This is the agency that I mentioned. And I believe it's on page 27 through 30. You can actually see the map of Louisiana, pretty much half of it, close to half of it in the red. And I ask people all the time, where are the communities from Lake Charles over to Plaquemines Parish supposed to go if they're not reinsured? And if we're advocating for relocation? And if they're leaving, or are you preparing them with jobs? And if you're preparing them with jobs, or are you preparing the communities that are going to be taking them in? So one of the things that we have been looking at is who are going to be the communities that are taking in other communities from coastal states. We have to also consider the infrastructure needs. New Orleans is actually increasing in size, even though we don't have the infrastructure to hold that many people. And holding people from coastal communities, even though our infrastructure in Orleans Parish, excuse me, is actually degrading, right? And it's one of the oldest infrastructure systems in the United States. So one thing that I haven't heard in this conversation is who are the incoming communities, and are there policies and protections for them as well? Schools, jobs, infrastructure, both water, energy, can they hold those communities? And who's willing to take those communities? You can look at many institutions across the United States where communities move and people are not willing to take communities that are struggling with climate migration on a mass scale. So while we have a trickle-down problem right now, right, where if you can afford to leave, you leave and you go to a city. And actually, it's ironic, people from Southeast Louisiana are going to Houston, which is also flood prone. And Houston's the fastest growing city in Texas. When Houston is underwater, where are those people supposed to go? 14 billion, I believe, close to people, where are they supposed to go, and how are we supposed to help these coastal communities? People don't think of Houston as a coastal city, but it is a coastal city. So there's a lot to consider that, you know, with Dave's plan is not relocation seems feasible on the front end, but is it actually feasible on the back end? And I don't think we're actually having that long-term discussion.
Yeah, I agree. I mean, but I don't think that the insurance industry is going to solve that problem. That's going to require state and federal legislation and substantial resources to help communities with managed retreat and relocation of their populations in areas that are not sustainable. What the insurance industry is telling us is those areas are not sustainable. That's why we're jacking up the price, and that's why we're getting out. And I'm saying, okay, well, we could either take our limited, taxpayer resources and put them into the very things that Jessica's talked about and others talked about with regard to mitigation, relocation, adaptation, or we can shove it into some massive insurance scheme that will help people stay in these various places and encourage them to stay, and actually encourage more people to move in because we've made insurance, super affordable. That's really the story of the NFIP. And I'm saying I know where I am on that choice. Put the money into what Jessica's talked about, not into some massive insurance scheme, but at the same time, do some things to make sure that insurance remains affordable for the folks that are still there.
Well, let's go ahead and take some questions from the audience. I appreciate everybody who's already offered a question in the Q&A. If you do have a question, go ahead and add it. We'll try and get to it. But just picking up on some of the conversation here, there was a question earlier. I think it was Jessica who raised the Community Development Block Grant disaster relief funding, and I think it applies more generally to other federal disaster funding, essentially being a form of reinsurance where people feel like, well, even if I'm not fully insured, if I have a disaster, I'm going to get a big chunk of federal aid to come in and help me recover from my costs. And I think the question is, well, are we making that money and that backstop, financial backstop, too easily available without having expectations that there be comparable efforts to invest at the state and homeowner level in practices that discourage the rise in the disaster costs, like building to current codes or not building new development in really risky places? Should there be more of a, I'm not sure it's a quid pro quo exactly, but more of a connection between the disaster money that's been coming and is likely to keep coming in the future to expectations about understanding and adapting to risks.
Jessica, do you want to jump in, or I have a?
Yeah, I'll just be brief and say that that's what I think Jeff already did a great way of framing it. That's a considerable issue in Louisiana, right? Every time there's a national disaster declaration, we get funding from both, community block grants, FEMA, HUD, you name it, NOAA, sometimes Army Corps of Engineers also may step in if it's a Mississippi River challenge. None of those funding cycles require changes to building code. None of them require changes of risk mitigation. They just require you to rebuild to the standard that you were in. That is a massive, challenge that we're seeing in Louisiana, where communities have rebuilt, and some of them 5 times in the last 10 years. Can you imagine that? And none of them actually support you to rebuild better. And I think I used this example last time I spoke to Carolyn. My mother had to get her roof replaced. She wanted a better option. She requested a better option from the insurance company. She requested a better option from the city. They said the only thing we can do for you is to build the standard that you already have. Knowing that there's a fortified roof program, she did not have access to that and was given the lowest grade type of roof, even though she wanted better. And so it's a partial, you have communities that want to have risk mitigation, but the insurance companies are not incentivizing it, and the federal fundings are not incentivizing it. So I just wanted to, that's really the struggle in Louisiana that we're seeing on a continual basis. But Carolyn, please take it from here.
No, that story is very moving to me, because I think it's quite upsetting that disasters really should be this opportunity for us to build back better. We know the areas that are high risk, and we also know how to build strong, right? I mean, like the IBHS fortified standards are proven to dramatically reduce losses, and yet time after time, we're putting households back in places where we know they're just going to be hit again and built in ways that we know are unsafe. And I think that's really unfortunate. It's going to require changes in both our post-disaster federal policies, how they're implemented by states and localities, and things like private insurance to also be providing extra funds and technical expertise to make sure that those changes happen during rebuilding. I also just wanted to quickly come back, Jeff, to a kind of earlier part of your question, which I thought was kind of touching on these questions of like moral hazard and like does our assistance create perverse incentives? And I think definitely the fact that it's failing to help us rebuild stronger is a problem. But I think it's also, when we're thinking about our post-disaster aid, we need to separate out money that goes to households from monies that goes to states and local governments, because it is a misunderstanding that households get anything close to made whole from federal dollars after a disaster. The amounts they get are often nothing. When they get something, it's like a few $1,000s. The program is intentionally designed not to make households whole, to just get them back to safety. And sometimes they don't even do that. And there's a lot of research that there's also a lot of procedural inequities in these programs as well. Although FEMA, to their credit, I'll say, has made some really important improvements to their individual assistance grant program under this administration. And so we'll see how those play out, but I'm hopeful about those. But households cannot rely on the government to get back on their feet after a disaster. So I just wanted to kind of, the question about moral hazard for local governments, I think, is a different question. They get a lot more money, but I wanted to make that distinction.
I just would like to add that under the Obama administration, they tried to create a system that would incentivize better action at the state level. It was called a disaster deductible. So appropriations post-disaster would be reduced if a community or a state had not invested in risk reduction measures in advance of the disaster. So that would be better building codes, land use decisions. It just never went anywhere. There's too much political pushback from vested interests as to maintaining the status quo. So it's really hard for the federal government to use that lever to get communities to better protect themselves.
We have a couple of questions on some specific points. I'll just raise them here quickly if anyone wants to jump in. The topic of coastal armoring came up, and to what extent practices permitting, for instance, with respect to coastal armoring and shoreline degradation might be a measure for helping to reduce risk, or perhaps a further consideration in some of the insurance premium price settings. Does anyone have thoughts on what a good policy for shoreline armoring is?
I'm just pointing, I keep referring to this document because it is really, really good. The Coastal Louisiana Plan is really, really good, and I do recommend reading it. I think the other, in terms of like shoreline protection and nature-based solutions, it's really important also to be, and I think I actually see that comment in the chat about the Army Corps of Engineers. They're actually finally having a nature-based solutions office that is actually starting to think about how the ports can actually embed nature-based solutions. I'm not sure, I don't know if Dave or Carolyn or Alice is aware if they have a report yet. I just know that their office is starting to finally work on these issues. And I really want to point out, I want to speak to a statistic, I can't remember, I wish I had the exact number on my mind. But during Hurricane Ida, you know, many of the communities that saw unprecedented damage during Hurricane Katrina, because of the ongoing coastal restoration efforts, I think it was something like 80% of those communities saw absolutely no flooding. So we know nature-based solutions work, and I think Dave had quoted some other communities that had similar benefits. So we know that it works. What does not work is when homeowners insurance and flood insurance are not speaking to each other. And so many of those communities were elevated, and I think I put that in the chat, but they didn't require a fortified roof program. So now they're up in the sky and the wind is strong and they lose their roof. And then many communities that's why many of the communities I mentioned were struggling, where they had open roofs still to this day, because it's who do you blame for that, right? I elevated my home, and you didn't require me to get a fortified roof. So the homeowners insurance are saying, well, it's flooding, and they're like, well, the flood came from the sky, not from the ground. And so these are why, you know, I see like what does the planning look like? It has to be conversations between all levels of government and different forms of insurance. You're going to keep running into these issues no matter where you're going. And I also want to point out with the relocation measures, what are the risks? We've been talking about flooding, right? But then we haven't even talked about wildfires and tornado risk, right? In Central North America or the United States. And so there's always going to be risk. What does it look like to have risk mitigated across all different sectors? And I think that's also another big red flag that we haven't talked about.
So I just want to make one other note. You know, we're having a real-time experiment in Florida as to whether giving insurers pretty much all they want is going to be sufficient to keep them writing in the market. And so insurers rates in Florida about 3 to 4 times the national average. Florida's created 2 publicly funded reinsurance facilities. They've limited assignment of benefits. They've limited attorney's fees for lawsuits against insurers. They allow reinsurance costs to be included in rates. They allow forward-looking probabilistic modeling over a longer time horizon, a point that Carolyn raised earlier. They've done all these things. And yet, you know, the jury's still out whether that's going to be sufficient to bring back the private insurance market in Florida. I mean, as Alice alluded to, or some of the other speakers, I mean, I think the last count, Citizens was at about 1.2 million policyholders. They're trying to depopulate. But Florida's had this kind of ebb and flow of, you know, hurricanes, insurance companies go bust, insurers leave the state, then opportunistic capital comes back in, some small companies get formed, they make some money, and then they lose their shirts again. And so, you know, we may be approaching, in some geographies like Florida, a point where these sort of more traditional interventions really aren't going to work, because insurance at any price that anyone can afford is still simply not going to be enough for insurers to keep writing that insurance. So it's kind of a pessimistic note to close on, but if we're closing, but you know, I think that a number of the longer term and deeper interventions that various panels have talked about are really what's necessary here, because, you know, we're essentially reaching uninsurability in a lot of places in the United States.
Well, that does unfortunately need to be the last word.
No, it can be a call to action. You can reinterpret it in a.
Thanks, Carolyn.
we know we have a problem to solve here. Yes. But I think we are ready to close. I don't know if Madison wants to make any closing remarks, but I do want to thank all the panelists for all your thoughtful comments and your very helpful discussions prior to this actual event. I also want to thank the Environmental Law Institute for sponsoring the webinar. And I see Madison's on. I'll let you do the formal goodbyes.
Thank you so much to all of our speakers for joining us today. Thank you to Jeff for moderating and for all of your work preparing this program and creating the read ahead document. Thank you as well to Alice, Jessica, Carolyn, and Dave for all of your time and energy to make this panel happen. Finally, thank you to our audience as well for all of your engagement and great comments and questions today. As a reminder, you can find the resources shared by our speakers on the event webpage. The recording will also be posted to the webpage for ELI members to view within a few business days. Thank you all so much, and we hope you have a great day. Bye.